Thank you all for joining. This is Breakout Session 1 on data bias and course corrections. I'm Sean Higgins, an assistant professor of finance at Northwestern University's Kellogg School of Management. I'll be moderating this session today, and my research focuses on how fintech reduces barriers to financial inclusion and the effect of reducing those barriers on households and on micro, small, and medium enterprises, and particularly on women-led SMEs. Let me start with a quick overview of this session's motivation. The motivation is that you can have data without information, but you cannot have information without data. And nowhere is this more applicable than for technology firms and fintechs in particular. With fintechs heavily reliant on a variety of data, it's important that they have strong data governance across their business practices. And with artificial intelligence and machine learning becoming pervasive, particularly in their credit scoring models, for example, fintechs also need to watch out for underlying biases in the data that could influence their decision-making and product development. For example, if fintechs are using data that hasn't been checked for biases and is not fully representative, the underlying data may have a larger sample of male users versus female users, or it might have different types of male versus female users. And algorithms built on those data may then develop biases against women. And if those biases are not identified and addressed, this could lead to less than desirable solutions for women customers. Let me give an example from my own research quickly before we jump in. We're working with a bank that wanted to expand lending to low-income women without a credit history in a developing country. And the problem they faced was that the traditional sources of data used to lend to those women are often biased against women because women are less likely to have a formal credit history, formal labor earnings, or formal ownership of assets that belong to the household. Now, a lot of the promise of fintech comes from using alternative data sources, such as mobile phone data or financial transactions data. And those are hopefully going to be less biased against women. But even using those data, the algorithms may still have biases against women. And in particular, they might not take into account all of the ways that behaviors picked up by the machine learning algorithm differentially predict creditworthiness for men and women. So in that project, we're implementing a gender differentiated credit scoring algorithm that estimates separate models for men and women, which forces the model to take into account that various characteristics and behaviors that are picked up by the machine learning algorithm may differentially predict creditworthiness for men and women. And using that model, we found that 80% of women get higher credit scores than they would with a traditional model that pools data for men and women, which means that many creditworthy women would only receive credit if the gender differentiated credit scoring model is used. So as that example shows, fintechs should be thinking about whether their data are biased and whether they're collecting gender differentiated data, as well as whether the algorithms they're using are leading to biases against women. So on that note, let me pass the microphone to each of our panelists to briefly introduce themselves and their organizations in about 30 seconds each. We'll have plenty of time to go into more detail about what their organizations do as the panel goes on. So let me start with Ann Stonier.
Hello, everyone. Hi, I'm Ann Stonier. I'm the Chief Data Officer for MasterCard.
Great, thanks, Joanne. Tejasvi.
Hi, everyone. I'm Tejasvi, and I'm the founder and CEO of Rupee Power.
Thanks, Tejasvi. Juan.
Hi, I'm Juan E Saldarriaga. I'm an entrepreneur here in Colombia, one of the founders of the Colombian FinTech Association and CEO of Juan Te Presta.
Thanks, Juan. Daniel.
Daniel Gutierrez from Banco BHT Leon. I am the Chief Digital Officer in Dominican Republic.
Great, thanks. So as you can see, we have a mix of financial institutions. We have MasterCard and a commercial bank, and we also have fintechs like Rupee Power and Juan Te Presta. Let me start with a question for the fintechs. Juan Te Presta is a B2C credit company and Rupee Power as a B2B credit scoring company. Do you have access to gender disaggregated data? And does that data play a role in any of your decision making? Let me start with Juan.
Yes, in Juan Te Presta, we developed two algorithms, one for men and one for women from the start. From data what we had collected from Experian here in Colombia, the non-performing loans in women was half the percentage of men. And so we decided from the start to be biased in favor of women and develop an algorithm in their favor. And since the start, that algorithm has approved much better than the men algorithm. And we wanted to have a loan book more skewed toward women because women are better payers. And we wanted to target specifically. And we had to develop an algorithm that, let us, tap that information that we could get from income and credit history in the credit bureaus for women. So from the start, we did skew our algorithms towards women, and because general algorithms wouldn't work, they would discriminate against women if we used the general algorithm.
Great, thank you, Juan. So that's an example, as I mentioned in my own research as well, of gender differentiating the algorithms, and that can do a lot better for women, as Juan was saying, and as I mentioned from my own research, than just even including gender in an algorithm, even allowing the machine learning model to use gender in any sorts of interactions it wants can still not pick up all the ways that different characteristics differentially predict creditworthiness. So as Juan was mentioning, separating those models can go a long way to helping to reduce the bias against women in credit markets. Tejasvi?
Hi. Rupee Power is a digital lending software product used by about 15 to 20 large banks, non-bank lenders, and some fintechs in India. Most of our partners who use our product, which covers all stages of the funnel, application, decisioning, and dispersal, do not have any underwriting criteria or specific criteria for women. It's generic across both men and women. So as we go further into this conversation, it would be interesting to see how not having any bias, as in terms of not having any specific rule for gender, could actually end up affecting credit or distribution of financial products for women across the general population.
Thanks, Tejasvi. And yeah, that's a very important point that in the US, for example, credit scoring algorithms can't use certain variables, including gender. So I'm sure we'll talk more about that as the panel goes on. Let me now ask a question to the commercial bank on the panel. You've been working with the Alliance for a while, Daniel, at Banco BH de León. What are changes that you've made to collect gender disaggregated data, and how do you use those data across the financial services provided by BHD?
Okay, BH de León is the second private bank in Dominican Republic, and we launched the gender strategy in 2015. At that point in time, we had disaggregated data for individuals and for most of the SMEs, because there are individuals that have small companies or small entrepreneurs. What we have been working in terms of the different value propositions, what we have as a result of this launch is that the growth for women, that at 46% of our customers, has been the same as men. Actually, last year, we did some specific model, not necessarily with social demographic, but also with behavioral data, not separating men and women, but the results is that women were approved. 67% women were more approved than men within that algorithm. So even though we don't have different models, the results because of the behavior has been much more higher.
Great, thank you. And now let me go to Joanne and MasterCard. Joanne, I've seen that you've spoken and written in multiple publications about the importance of strong enterprise data governance programs around uses of machine learning and artificial intelligence. Could you talk about why data governance is so important for AI/ML innovation and the role it can play in helping to identify and mitigate gender bias?
Yeah, sure. I'm listening to the conversation. I think that there's some great examples of how data governance actually plays a role in identifying both unintended bias, I think, which is one of the things that you want to guard against, as well as getting to the right outcome. And so, you know, we have a kind of 6-step process at MasterCard that we use for governance around our artificial intelligence and machine learning process, because we recognize that strong governance really should, first of all, you know, align your organization with what you're trying to do, and also identify and mitigate kind of your data risks and minimize those unintended data biases by making everybody aware of what you're trying to accomplish. And I think what we've just heard in some of the examples that were given is the first step is really understanding the purpose of what you're trying to accomplish with the AI and machine learning. And that's really the first step in our governance process, right? If you understand the purpose, you can begin to also then go through the next step, which is what data are you using? What are those data inputs, if you will, to make sure that you're using the right data for the purpose you're trying to accomplish. You just heard some examples of where you want to amplify the ability to give credit to women, for example, but then you understand that that there may be inherent bias in the input data that work against women. And if you know that, then you can begin to look at that data set differently than if you didn't understand that purpose and you didn't understand that input data properly. The next step is understanding the structure of your analytic inquiry or your models, right? Because you can also have bias and you structure your inquiry. And so that's really important to understand, how are you structuring your inquiry so you also get the right output. And so that's the next piece. And then the third part of our governance is putting those two things together, the data with model, to make sure that it's actually going to work in somewhat of an intentional fashion. And our fourth step is really understanding those use cases and the data together. And so are we really doing a model risk scoring to then begin to see the outcomes and the drift, right? Is it intended drift? Really, is it what the model is intended to do? Or is there some still unknown variable or unknown input or unknown structure to your methodology that you need to address because you're not getting your outcomes? And of course, you're going to do, once you think you have it right, what are impact assessment on the population that you're going to apply this to? And so that's the fifth step in our governance process. And then kind of the big magic that that we've deployed on a smaller scale that we're trying to do on a large scale is using observational AI over the whole process to kind of then, once we actually ramp it up and we're actually into machine learning and AI, can we continuously see what the machine is learning to see, do we have additional bias that we have to understand in how the machine's learning? That's harder to do at scale, right? It requires incredible computation power, but it's one of the things that we're dedicated to in understanding how are we learning and how is the machine learning? Is it learning our biases? Is it picking up unintended information that we haven't cut as we've tried to go through the governance? So that's kind of an overview of some of the governance work that we're doing at MasterCard as we look at this area, because we believe we're at the first generation of this fantastic opportunity. But if we don't pay attention now, the machines are going to learn things that we may not have intended it to. So that's a little bit about what we're doing.
Thanks, Joanne. That's a very helpful framework for thinking about both data bias and algorithm bias. And that's actually one thing I want to emphasize to everyone in the audience, that it's not only the data that can be biased. So the title of this session is Data Bias. It's also the algorithms that can be biased. So you really need to think about both of those potential sources of bias. I think it's also a good time to mention, as we're talking about both data bias and algorithm bias, some of the research that the Financial Alliance for Women conducted by interviewing a number of fintechs. So they asked what these fintechs were doing in their algorithms to mitigate potential bias, and there was some mix of different methods. Some are incorporating modeling techniques for algorithm bias. About 19% of the fintechs were doing that. About 17% were doing something with the training data set to try to account for sampling bias. Another 12% were doing something with the training data set for participation bias. But I think a main takeaway here for me was that there's a lot more that can and should be done on the fintech side. So kind of sharing information about how different organizations are working to mitigate both data bias and algorithm bias is very important and can go a long way with the fintechs. Now, we mentioned a few times throughout the panel, the different, a number of our speakers mentioned, potential use of these gender, for example, gender in a credit scoring algorithm. Juan mentioned it to say that they're doing a gender differentiated algorithm separately for men and women. Tejasvi mentioned that they don't use gender in the algorithm, so it's a gender blind algorithm. It doesn't take into account gender. And for example, in the US, we can't take into account gender due to regulations that were intended to prevent any sort of direct discrimination on gender in the models. So I think that's a good time to think about a recent example that did happen in the US that you all may have heard of, which was the Apple Card scandal. And for those who haven't heard, what happened was that Apple had developed a credit card with I believe it was Goldman Sachs, who was doing the credit scoring and basically offering this credit card in a way that was supposed to be kind of fintech, in that you can just quickly apply, get approved, and have the card, and you would find out what your credit limit was. And the scandal came about because someone posted on Twitter that they had received an approval, but that their credit limit was about 10 times higher than this man's credit limit was 10 times higher than his wife's credit limit, even though they had shared financials, and that she in fact had a higher credit score than he did. So there was no reason for the model to be giving a higher credit score to them. Now, related to this point about should we and how can we be using gender in these credit scoring models, the defense that Apple put forward was that, well, we don't use gender in the model, it's gender blind, and so how can it be biased against women? But an important point is that gender bias is not the same as gender neutrality. So let me first pass it to Joanne to talk a little more about how they think about this at MasterCard.
I'm laughing only because it was a quick defense, right? But it didn't hold up well. And I actually think the number was something like the gentleman received 20 times the credit than his wife, and I applaud him for being outraged on her behalf. And but just because you don't select on gender doesn't mean that our data sets are not biased in and of themselves, and that the machines pick up things that we have not been as aware of in the criteria. So, Sean, you mentioned in your opening remarks, right, the work that you have done and the unintended bias, right, that is buried right there if you're just using, I'll use income as a data point, right? There is unintended bias in the data point of income against women, right? Why? So if you have gaps in your income history, right, that works against you for credit scoring. And why would a woman have credit gaps or income gaps, right? Well, she might have an income gap or two because she took time off to raise children, right? That works against, and it may look identical, right? So for a length of time, right, you're just looking at earnings, right, income coming in for an individual. But if there's a gap, a time that stops, that's going to work against an individual, right? It's going to be assumed by the model, unless it's adjusted somehow, that time off is a time no income was earned, and it was therefore that individual was not worthy of credit, and so therefore it works against women. There are all sorts of subtle bias in society, in all sorts of societies, right, that work against them, and even though gender is not present as a data element, right, in the model. And that was really what was happening, I believe, in the situation that we're talking. And it happens over and over again with things like credit. When you're trying to do things according to education, right? Women can have gaps in education as well. We know that women actually do repay better. So if you begin to look at other variables, right, where women can be stronger, and you add those into models, right, you make the model much more holistic, all of a sudden you can get to what we would call gender neutrality in a model, rather than just using what looks like a neutral variable, right? So income looks and sounds like an incredibly neutral variable, Doesn't say male income versus female income, right? Just says income. But what we know is that you actually have to look at the purpose of what you're trying to evaluate, and then you must look at those inputs to understand, do they have any type of coverage bias or inherent bias that's going to actually show up in your model? And that's why we talk so much about governance, because again, unless you really train up both your algorithmists and your data scientists to really think this through, you wind up with these unintended consequences, because you're not thinking, oh, I'm trying to be, kind of eliminate all my biases, but you're eliminating the obvious data points, not the inherent ones. So it's a great fun story to talk about, but did ultimately correct it in all fairness to Apple and Goldman. They did correct it.
Yes, I should have mentioned that as well. Thank you, Joanne. So Tejasvi, you mentioned that your organization doesn't use gender. Could you explain a little bit more what went into that decision, whether it was a regulatory issue or another issue, and how you then think about the comments of Joanne, or what other methods you could use to take this more holistic approach that Joanne mentioned and make sure that your models are gender neutral?
So in our case, we are a pure digital lending software product. So the underwriting criteria and the decisioning frameworks are all of the partners who actually use our product. Having said that, in more than 90% of cases, I think it's a gender neutral scorecard or rule criteria. In some cases, it's actually biased towards women in terms of lesser income criteria, as in the income criteria is either lowered or the stability criteria are actually relaxed. But I want to touch upon this. When we started looking at this data, we said, let's look at the 5 million odd customers who have got credit cards and unsecured personal loans using through our partners using our product over the last 5 years. And when we looked at the numbers, it's funny, right? We found that only 8% of overall disbursals were to women. Now, credit cards and personal loans are mostly to higher and white-collared salaried segment. So when we said, is there a bias in or some kind of skew in the underwriting or decisioning frameworks? And we looked at a number of cases one step above in the funnel, which is number of cases decision. The percentage there was just 7.5% of women. And this is in the backdrop of white-collared women participation in India is about 20 to 25%. So we said, let's go one level higher. Let's look at the number of applicants or visitors who are women. And the percentage came out even lower. It was like 7%, 6.5 to 7%. So what we see here is a slightly weird phenomenon. If anything, risk managers seem to be more inclined to have women as customers, but there don't seem to be enough prospects at the top of the funnel. Now, this could be because of cultural factors, or this could be just lazy marketing at play. 80%, most lenders are generic in nature in the sense they don't have segmented target markets for men and women or products. So it might just be a lazy marketing approach which says, let's target the median customer. Now, hey, if 80% of your workforce is men, the median customer is a 35-year-old man. So most targeting of your communication, advertisements, products goes towards that median customer. So we see a little bit of, an anti-obvious insight here that there is more bias at the top of the funnel than anything that happens within the funnel till the point when the product is actually disbursed to customers. That's been our first our understanding of the phenomenon.
Yeah, and that is a really important insight as well. I know the Financial Alliance for Women's report mentioned a lot that the fintechs don't know about the particular business case for why they should design products specifically for the financial needs of women, and that's led to some kind of women-founded fintechs specifically trying to do that because the women founders had the same experience that the financial products in the market were not really addressing their needs. So that's something that it seems there's still a lot that can be done in terms of how the fintechs advertise their products or design their products to get to fix that top of the funnel problem. On that note, let me also pass it over to Juan and ask how your fintech has thought about and dealt with either the issue of increasing the funnel and targeting your product towards women, or the algorithmic bias.
Yes, we do target specifically on the marketing women. We do have historically same top line funnel applications both from women and men, except when COVID struck, women started applying less. And the algorithm also stopped approving because the algorithm has income, and women have been hit much bigger time with COVID than men during the lockdowns here in Colombia. We go to Social Security information, and for that, the algorithm, I guess, was working properly since women were having less income, so the approval rate went down, which was not the case before COVID. We do some of the variables that we have in the algorithm are number of products, and women usually have less number of financial products than men, so we had to take that into account. Income was different, so we also take income. There's same type of job, probably women has a less income, and so we had to take into account that. The time that they're in the credit bureau, which is also part of the algorithm to see their experience with financial products, for women is less. And so like those variables, there's a lot in bias in the data that we had to take into account, and that's why we separated the algorithms. Now that the lockdowns have been seized here in Colombia, applications for women have come up. I think women are more prone to be responsible on their lending. So when the lockdowns were in, women stopped applying. Now that the lockdowns have been removed, we see more women applying, and the algorithms are going back to the approval rates before COVID, where women got approved more than men, even using the two algorithms. So for us, it's behaving as we think it should behave. And in the long term, we think that women are going to be repaying their loans better, even if they were hit harder during COVID.
Great, thanks, Juan. And Danielle, Juan mentioned also this phenomenon of COVID having an impact, potentially a differentially greater impact on women, which could affect them in these markets as well. At BHD, I know you've been leading the digital transformation. How do you think about both the ways that these biases could affect women, and potentially, if there are any examples in the COVID context itself, how COVID might differentially affect women, and how does that affect the financial services, the digital financial services that you're providing?
In terms of marketing, since we have a strategy in place for and a value proposition for women, so the funnel in terms of the applications have been going through during the last year. So that's a very important in order to get the results. The number of applications and the number of approvals are related to the proportion or the market share in terms of the number of women customers versus men. Definitely, income is one of the elements in terms of our country here, and Latin America and maybe the world. There's a differentiated income for women and men, so that meaning that the impact of the amount that it's approved definitely changes between genders. When we talk about COVID, the thing is that 44% of the small SMEs are owned by women in Dominican Republic. So definitely those small SMEs are being struck much stronger than larger SMEs, and they depend a lot more in terms of operational funding. So what we expect, and with this just starting here in DR, is that definitely they're going to be affected. But we also have seen that women pay better than men, and women are much more responsible in terms of asking for loans than men. So even within the impact because of the ownership is going to be strong. I believe that, and we see that in terms of the models that we're looking in terms of risk models. Women are much better positioned than men for a specific number of loans. Again, without having algorithms for men and women separated. That will be interesting to see how it works.
Great, thanks, Danielle. All right, now it's time to move into the audience Q&A. So if you have the Slido app and you have a question, please go to Breakout 1 in the app and type your question in there. I'll kick it off with we have a few questions in here already. The first one is for MasterCard. What are some of the different kinds of data biases that can appear in financial data? And can you offer a few best practices in addition to what you talked about before that organizations should consider before using financial data for decision analysis?
My goodness, that's a question and a half. I'll try to do my best with the time we have. So there's all sorts of different biases that you can talk about that show up in all sorts of data, right? So I mentioned coverage bias when data is selected in a representative fashion. Sample selection bias occurs when data collection is not randomized, and so you may have an issue of a population being scented. We just talked about male versus female. You can have problems with minority data. You also can have participation bias, right? If you don't understand how a data set has been collected, when it's not representative of the type of population you want to actually target for a financial product or service. So we've talked a lot of my colleagues on the panel have talked about how they have actually adjusted for that non-participation bias in that the data has represented women. I think Tejasvi actually spoke very, very specifically about that. You also can have also self-selection bias or volunteer bias. And I couldn't help wondering, that women so often do not put themselves forward in a lot of financial contexts. Culturally, the selection process or, going forward for a loan or insurance or credit is oftentimes a process that culturally they have not been acclimated to. Generally, we have seen that, finance has been traditionally perceived as a male's area. Fathers talk to their sons differently than they talk to their daughters. And so participation and self-selection bias are issues that we see show up in financial data. We have measurement bias, we have cognitive bias that we see with our analysts and our scientists, and sometimes depending upon how they frame a question, that's kind of it's a way of searching for a question together that confirms what you believe. And so you have to make sure that you're opening your mind, and sometimes framing a question both ways is how we put it at MasterCard. So to make sure that you're not saying, I'm trying to think of a quick example, but confirming a pre-existing belief that you want to answer the question both ways so that you make sure that you don't have that. But those are just some quick examples of different types of biases and the way they can show up from a financial perspective. I'll yield the floor because I'm sure there's other questions. Happy to have a chat with somebody offline on this. It's a longer and more complicated topic, and I'm sure my other panelists can join in answering that.
Great, thank you, Joanne. And that's very helpful as well as a segue to the next question, which is about bias frameworks. You laid out a nice framework by describing some of the different types of biases that could that come into play. So now I think this one can go to both the fintechs and the bank. So I'll let whoever has a response jump in and answer. Do you think you could create some bias frameworks that could be either used in your own decision-making processes or suggested to any banks and financial institutions or other fintechs that you're working with? If so.
Yeah, I'll take a first stab at that. I think simple first order alternate data bias that creeps in is income. If you look at how much our what should I say, opaque your model is, because it just looks at a lot of, what should I say, both data which is vast as well as deep. I think most machine learning algorithms end up using income as a proxy for creditworthiness. Now, it's a well-known fact in almost all parts of the world that for the same job, women get paid around 20 to 30% lower than men. It's a pretty well-established fact in a lot of countries and industries. So using just income and cutoffs, hard cutoffs, as one of the, what should I say, as one of the proxies for creditworthiness will generate an inherent bias in how decisioning is done. I think that's a very straightforward first order, what should I say, bias that gets created in most of our decisioning criteria.
Great, thanks.
I would say that I think we need to work with the local credit bureaus because there are many financial institutions use their off-the-shelf scores, and I think at least in these countries they're not unbiased against women. I think they need to be they need to work harder for the income and the impact on women in general to accommodate that. And I think none of those standard scores from the credit bureaus do take into consideration those differences between women and men, to my understanding. That's why at the end we need to develop our own algorithms to favor women, because if not, using standard algorithms from the credit bureaus or scores from the credit bureaus, they will, like the FICO scores and that type of scores here in Latin America, I think you're going to be under approving women in general. So I think there's a lot to work with in that sense with the in the financial institutions, in their algorithms, and with the credit bureaus would be my take into that.
Great, thanks, Juan. Yeah, and that's a topic for a whole nother panel about how credit bureaus can use fintech data, how they can use alternative sources of data to improve their credit scores. We have about 1 minute left, so let me just ask one final question and see if anyone has an answer they want to jump in with, which is, if you could wave a magic wand, what would you wish for to reduce bias in the system? And I think I'll just have one person talk since we have about 1 minute left, if anyone has a response to that question.
I believe that having independent algorithms is one thing that we need to work on, understand, and see how this is compared with the current algorithms. So if we don't have data that supports if it is biased or not, we're never gonna have the solution or the question solved. So that would be not necessarily magic, but it's data-based analysis and fact-based decisions.
Yes, excellent point. Thank you, Danielle. So that wraps up our session. Let me just close with one final comment, which is that I saw in the Financial Alliance for Women report that there's $1.7 trillion of unmet demand for credit among women-led SMEs in developing countries. That was kind of a shockingly large number to me. So to all the fintechs and financial institutions in the audience, that's something to keep in mind as you think about how you can design your products to meet the financial needs of women and to reduce bias in both the data and the algorithms used to evaluate their creditworthiness. So thank you everyone for joining. When you leave the session, please go to the main page and click on the pink house to go back. That concludes our session. Thanks so much.